What's going on with the Republican tax bill? How different can state budgets really be from one another? And how does Amtrak justify its hardly used services? I'm Dominic Pino, Thomas L. Rhodes Journalism Fellow with the National Review Institute, and we'll look through those questions on this episode of Econception. Econception is a podcast of the American Institute for Economic Research that looks at the economic issues of the day and the broader economic concepts behind them. We're recording today on location from the Federal Income Tax Code, so make sure you save this podcast for the next 7 years. You may have heard that there's a tax bill going through Congress right now. Republicans are trying to pass through the reconciliation process, a major do-over of the individual tax code and some parts of the business tax code as well. Here to talk about it is Adam Michel. He is the Director of Tax Policy Studies at the Cato Institute and has written lots and lots about tax policy over the years and has been following this debate very closely. He actually has a piece just recently out at National Review talking about the green energy subsidies. So why don't we start there? Joe Biden in the Inflation Reduction Act introduced a whole bunch of energy subsidies, but of course, the federal government has been subsidizing green energy for a very long time in many different forms. Republicans in the House have introduced in their first shot at this legislation some pretty significant cutbacks of that. Can you talk a little bit about that and why it's a good thing or a bad thing?
I can. Thanks for having me on. This bill is sprawling and does many different things. I think one of the bright spots is the repeal of these green energy subsidies that were included, that were passed under Joe Biden, as you said. And Congress was initially told that they were going to cost about $270 billion over 10 years. And after the law was passed, other estimates from outside of Congress and then the congressional scorekeepers have since caught up, have tell us that these subsidies will cost well more than $1 trillion, close to $1 trillion over 10 years, close to $5 trillion through 2050, according to some analysis from my colleagues here at the Cato Institute. And so this bill repeals somewhere in the neighborhood of 60% of the fiscal cost of these credits. It ends a lot of the individual credits pretty immediately, like the tax credits for electric vehicles and for making your home more energy efficient. And it phases out and puts some pretty strict placed in service dates for the actual products that are getting these subsidies for some of the larger tax credits for energy production and energy investment.
Yeah, and why is that a good thing? Because, lower pollution's nice. We don't want to have pollution. We want to have cleaner energy. Why is this not a good way for the government to spend money?
Yeah, so beyond the fiscal cost of these subsidies, even if your goal is CO2 abatement, making the economy cleaner, this is a cost ineffective way to get there. The same colleagues that have the estimate of the cost of the IRA, Travis Fisher and Joshua Laux, estimate that the IRA will cost between $224 and $535 per ton of CO2 abatement. The Obama administration sort of benchmark is about $50 per sort of ton of CO2 abatement. Being anything above that means that you're not passing the cost benefit analysis. Biden's level is a little bit higher than that, but however you slice it, this is not an efficient way of reducing CO2, even if you think that is ultimately a good goal. At sort of a higher level, when the government's interfering in energy markets, they're making markets less efficient. Consumers are better served when they're in the driver's seat, when they're telling companies what type of energy they want, when they want it, and how much they need. And then the market decides what is the most efficient way to get to that end goal. And so one of the many problems with these subsidies is they subsidize energy that is intermittent. So things like solar and wind come online and go offline in ways that make the energy grid unstable and actually require then in new investments in things that are sort of base load or there all the time that then sort of increases costs and makes the entire system less efficient. So that's just one way that these subsidies distort these markets. There are also often people say this is a jobs program. It's also an inefficient way to create jobs. Some of the estimates are that jobs created from some of these subsidies are in the neighborhood of between $2 and $7 million per job created. So any way you slice it, this is not a good use of fiscal resources.
And I'm guessing the people that have those jobs aren't getting paid between $2 and $7 million, so it's probably not a good deal. Obviously, the reason, the reason that Republicans are looking to do this in the tax bill, one of the reasons, aside from it being just a bad policy for the reasons you just mentioned, is to offset some of the costs of tax cuts elsewhere. What are those tax cuts, and why are Republicans looking to offset them? What's going on there?
So in 2017, during the first Trump administration, Republicans passed what was called the Tax Cuts and Jobs Act, which was a landmark overhaul of the federal tax code. We hadn't seen a tax reform like this in more than 30 years. And it had many different pieces. It had business tax reforms that made doing business and investing in America more attractive. The United States used to have the highest corporate income tax rate in the developed world. We're now about average. And then it also cut taxes and simplified taxes for individuals in a bunch of different ways, brought down rates, expanded the standard deduction, put limits on itemized deductions like the SALT deduction and mortgage interest deduction. And all of that, except for the corporate rate changes, expires at the end of the year. And so Congress has to do something. And this bill is the something that they're going to do. The broader bill extends a lot of those, actually makes permanent a lot of those individual tax cuts, the rates, the brackets, the larger standard deduction. It adds a whole bunch of new things, which hopefully we can get into a little bit. And it temporarily expands some of the business provisions, like full business expensing, which is this really powerful incentive to invest more in America.
Yeah, one of the things that was a little bit controversial for about 5 minutes among Republicans was about raising taxes on the rich. There's Steve Bannon is one of the top advocates of this on the political right. He made some noise about it. A handful of other people did as well. But as you said, the bill that the House actually passed does keep all of those individual tax cuts in place. But before we go on to the other things, what's wrong with taxing the rich a little bit more? They have lots of money. Why don't we take a little bit more from them? I mean, we clearly aren't raising enough money right now. We have huge deficits. So why not just take some from the rich?
Interesting framing. I wouldn't say that we need to raise more revenue. We have a spending problem, and so the answer is not always more revenue. It's sort of right sizing the spending side of the ledger. The revenue as a share of GDP right now is about at the historical average. So we're not hurting for federal revenue. In the United States, the highest income Americans actually pay higher tax rates and a larger share of their income than many countries across Europe and other places around the world that folks otherwise would think of as having a tax system that is a lot more progressive than the United States. So even if you think the rich need to pay their quote unquote fair share, which is often a poorly defined term, the rich already pay an inordinate amount of the income tax compared to the sort of bottom half of income earners in the United States. Increasing their tax rates further has a number of effects. People work less. They start businesses less. It has impacts on entrepreneurship. In the United States, many, if not most, small and medium-sized businesses are taxed as individuals. So the top couple top tax rates on individuals are also the small business tax rates and the medium-sized family-owned business tax rates. And so raising those rates has sort of broad negative economic effects and moves the tax code to be even more progressive than it already is, sort of well outstripping basically all of our other peers around the world.
And so there were those other cuts that were added in. So, 2017, they cut a lot of the income. They cut all of the income tax brackets, simplified things, made the tax code much smoother for individuals. They raised the standard deduction a lot, and they're keeping that permanent higher standard deduction in. So that's really good, because it means now that most people, when they file their taxes, they don't have to go through the process of itemizing, because the standard deduction just gives them a lower tax liability. So why go through all the work? That's good for taxpayers, not having to do all that extra work just to get to the same spot financially. But they added some new things, some new cuts into this bill. The big ones that Donald Trump talks about the most are no tax on tips, no tax on overtime, no tax on Social Security, and perhaps most randomly of all, no tax on car loan interest. Can you talk about those additions to the bill?
The classic Republican sort of supply side recipe for tax reform has been broaden the tax base and use revenue you raise from that to lower tax rates. So if you tax more stuff, you can lower the rate and get the same amount of revenue. And that was more or less the recipe that was used in 2017. They put limits on itemized deductions, as we've talked about, the SALT deduction, mortgage interest deduction. They repealed a bunch of other junk in the tax code. And then they used that higher revenue to lower rates and then cut taxes a little bit more beyond that. This time, they are keeping tax rates low and adding new holes in the tax code, new special exemptions and deductions. By my count, there's more than 20 of these that they've either added or expanded in this bill. And you list some of the more politically salient ones, things like no tax on tips, no tax on overtime. Trump campaigned on no tax on Social Security. They actually didn't get that in this bill because of some arcane Senate rules. It's just a larger deduction for seniors. But all of these preferences in the tax code are tax cuts for very specific groups, and they come at the expense of lower tax rates for everyone else. If you think about something like no tax on tips, it's actually very politically popular, which is why they're doing it. But it means that you're cutting taxes for a waitress instead of taxes for someone working on a manufacturing floor or someone that is cleaning hotel rooms. And so, it's sort of at its core, I think a lot of these new provisions are unfair, and those resources we better use for broad-based tax cuts.
Yeah, I think the no tax on tips is a great illustration of that, because it's not just, you're cutting taxes for a waiter, but not for a manufacturing worker. You're cutting taxes for the waiter, but not for like the cook in the kitchen at the restaurant. Like even within the restaurant, you're not cutting taxes for all the people in there. So you can't even say you're helping restaurant workers more broadly. It's really just tipped workers. There's lots of non-tipped workers in all of these places that tipped workers are. It's a very strange thing to carve out. What do you think? Do you think this is an improvement of the tax code overall? We have those negatives in there. The positives of the green energy side. In the last several days, we've heard from the Senate that they want to make permanent full expensing for business capital investments. Can you talk a little bit about that? I know that's something that you support and has been on a wish list item for a lot of free market people for a long time.
Yeah. Full business expensing, or 100% bonus depreciation, it sort of goes by a bunch of different names, basically just says that if I'm a business and I'm going to buy a new piece of machinery or a new piece of equipment, I can deduct the cost, the money that I spent on that investment in the year that I make it. Just like when I pay my workers, I get to deduct the wages I paid them in that year against any revenue that came in. I should be able to do the same thing with physical investments. Our normal tax code doesn't allow you to do that. It requires you to spread the cost of that investment, the deductions for the cost of that investment over time, as many as 39 years in the case of a building. And because of inflation and the time value of money, those deductions lose value over time. And so this system of depreciation, of having to having to carry these deductions out over time raises the cost of investment in America. The longer you have to carry these deductions on your books, the more expensive it is to make that investment after tax. And so full expensing just says, we're going to get rid of that penalty against investment. We're going to treat all investment equally by allowing you a full upfront deduction. This was one of the most pro-growth components of the 2017 tax cuts, in a sort of right behind the permanent corporate income tax rate reduction. But unfortunately, it was temporary. And in the House version of the bill, they've extended it, but they've also made it temporary. And unfortunately, temporary policy doesn't change long-run incentives nearly as much as permanent policy. So in my view, setting aside all the new carve-outs that we talked about, which I think are also not great policy, the big missing piece of this bill is making these expensing provisions permanent. And I think there's hope and some reporting that the Senate will do that will make these business investment incentives permanent. And that paired with the IRA changes, I think will make the bill much better than it currently is. But it is unfortunately still being dragged down by all of these new holes in the tax base that not only lose a lot of revenue for not very much economic growth, but also add a lot of complexity to the tax code when people have to go then file their taxes and figure out all these new provisions.
Yeah, I think full expensing is a great example of a policy that a lot of people don't understand, but when you actually think about it a little bit, you realize how unfair it is and how harmful it is to the economy to not have the ability to do that. Like you said, when businesses pay their workers, they get to write off that expense every year. This isn't some like special handout to businesses. This is just common sense because you don't want to tax businesses for paying their workers. That's bad. We want them to pay their workers, and we want them to give them raises. So if the government treats the money that the corporations use to pay their workers as though that should be taxed, that harms the incentive to do that. So we already realize that on the labor side of the equation. But for some reason, when we go to the capital side, where we obviously want businesses to invest in buildings and equipment and research and things like that, we treat it totally different, and we basically tax businesses on profits they never made, because when you subtract those expenses, how do you calculate profits? It's revenues minus expenses, right? So if you have that expenses number be lower than it actually is because you require them to spread that expense out over many years, in certain years you're taxing businesses on profits that they never made, and that's just really unfair, and it hurts the incentive to invest in the United States, which is something that Trump has talked about a lot, that he wants to encourage investment in the United States. So a great way to do that, that has nothing to do with any of his various trade policies, is to stop punishing American businesses for investing in the United States.
And I think it's important to go back to why investment is so important. And if you think about the classic sort of story that economists tell, it's that workers, sort of people, work with things, and the things are investment. And you need people and things to work together to make widgets, to make all of the products that are produced in the United States. And so when people can work more, or you can sort of have more people working. But the other way that you increase the size of the economy and you increase productivity, which ultimately determines what workers are paid, is you give workers newer things and better things to work with. And that's what investment is. And so by removing a disincentive to invest in American workers, you're giving businesses the incentive to upgrade their technology, to upgrade the machinery that people are working with, which is where the wage growth and the new job opportunities come from when sort of economists model these pieces of legislation. It's the combination of workers and investment that gives us the good economic outcomes.
Yeah, and it's that return on investment that's the really important thing that economists are looking at when they talk about taxes. A lot of times, popularly in politics, we talk about the effects, or the positive effects of tax cuts as being that people get to keep more of their own money, and that is a good thing, right? Because obviously, people are going to be people are going to spend their own money more responsibly and more sensibly than the government will spend it on their behalf. I think, there's a good argument to be made. The government is too large and it doesn't need as much money as it takes in, because it should just be doing fewer things in the first place. All of that is true. But the real thing that gets economic growth from tax reform is by increasing the return on investment, and that when we allow people to keep more of their money, a lot of times that's just going to get spent on consumption, which is good. It's important. It matters, but it doesn't get that long run economic growth in the way that increasing the return on investment does. And so when economists talk about taxes, when they look at tax policy, they're really looking at how will this help increase returns on investment, and that's why the full expensing provision is so important. And that's why, if you look at any economic model of this, if that provision's not in there, this tax bill doesn't really increase economic growth at all. And in fact, it might actually reduce it a little bit. But if it is in there, that helps it to get to a more positive place.
That's exactly right. You do get some marginal rate cuts on workers. People do work a little bit more when they get to keep more of their own money, but that effect is not nearly as powerful as similar cuts to the incentive to invest, because investors, as you alluded to, you don't have to invest. The other option you can do with your money is consume it today. And so if you make investment is just delayed consumption. And so if you make the return on investment, which is what the market pays you to delay consumption, if you lower that return, you're telling people that otherwise would invest, they should save and invest a little bit less and consume a little bit more today. And that means that workers have fewer tools and equipment to work with, which makes everyone worse off in the long run. And so that's why, as you've said, full expensing, lower tax rates on businesses, capital gains and dividends taxes, all of these pieces are what ultimately hit investment the hardest and have some of the larger effects on long run economic prosperity.
One of the weirdest things in this bill, I think, is the Trump accounts. This sort of came out of nowhere. I don't really remember this being a major topic of discussion during the presidential campaign or anything like that. But the House passed this bill, and they basically said we're going to give, I believe it's for newborns, you get an account with $1,000 in it or something like that. Have you looked at this provision at all, and do you have any idea where it came from?
So yes, this is one of the new Trump additions to the bill. And it is unfortunately poorly conceived in a couple of different ways. The idea that has been floating around in sort of the free market tax reform world is something called a universal savings account, which allows you to save your money like you do in a Roth 401k or a Roth IRA. Where you put the money in after tax, it grows tax free, and you can use it for retirement. Universal savings account says you can use the money for everything else other than retirement. You can save and invest for starting a business or a down payment on a house or whatever other sort of whatever other things you want to do later in life. It says the government isn't putting strings attached to the money that you're saving and investing. The Trump account takes that idea, but then perverts it in a couple of ways. It puts new strings on it. So it says you can only use this money for education and a down payment on a house and a couple of other things. It also doesn't have the full tax advantage that your 401k or a universal savings account would. It has some taxes when you withdraw the money. But then they say, don't worry, we'll deposit government money, taxpayer money into the account, $1,000 per kid. And this is more or less a remade version of an idea that has been popular among Democrats for quite some time that is often called like baby bonds or 401k kids. And this is just another subsidy scheme where the government is transferring resources that they don't have. We're running deficits to children, to families in a fragmented way. It adds another subsidy for children on top of the earned income tax credit and the child tax credit and tax credits for childcare. The list goes on. And this is just another one of these sort of ways the government is trying to hand out money in opaque and difficult to understand ways.
And like you said, the government doesn't have enough money as it is in terms of its spending obligations. We don't need to be adding more spending obligations on top of that. If you had said to somebody, 10 or 20 years ago, and, which in the grand scheme of things, not that long ago, that the federal government would be running $2 trillion deficits a year and with no sign of it really turning around, and that Republicans would have a chance with united control of government to completely redo the tax code and cut a bunch of spending, and the bill they're going to pass is actually going to add to the deficit in the long run, would you have believed them? And because that is where we are right now, and it just sounds crazy to me, but it doesn't seem to have any sign of slowing down or stopping.
It is crazy. You're right. Republicans have united control. They campaigned on cutting spending, reducing the size of the deficit. And instead, I think making the tax cuts permanent is important, but they're not matching it with spending cuts. And this is unfortunately the history of these things. Republicans like to cut taxes as much as the next guy, but they are less excited about actually fulfilling their promises on the spending side. This bill does cut spending in a bunch of important ways, but it doesn't go nearly far enough or do the reforms that are necessary to actually get our fiscal trajectory under control. As you rightly noted, this bill makes the size of the debt and the deficit worse over time rather than better. There's a lot of low-hanging fruit they still could go after. We talked about the IRA. They haven't repealed a large portion of it still. There's 40% of it still left in the tax code. There's, by my count, another 10 or so $1 trillion of what looks like spending, tax expenditures in the tax code alone that could be reformed. But then there's the whole spending side of the equation. They're not touching Medicare in this bill. There's any number of other spending programs that are eligible for reconciliation that they could incorporate here to actually right size get the government heading in the right direction. But I think this is I lay the blame at the feet of Trump on this one. He has, through his first term and now second term, he has not shown a commitment to actually cutting spending. But instead, he's more focused on all of these gimmicky giveaways like no tax on fill in the blank. And that's where the effort of the administration seems to be.
Yeah, it's crazy because, the long run problem here is the entitlement programs, right? It's Social Security, Medicare, and then the interest payments to fund those. But at the same time, like you pointed out, there's all these tax expenditures. There's all these other subsidy programs. There's a bunch of other stuff that you could go cut and really do some significant damage on the deficit. And they did some of that, and that's good, but they didn't do nearly enough. And so yet again, we are left saying, well, maybe next time. Thanks for joining us to talk about this, Adam.
Thanks for having me on.
So we just talked to Adam about the federal tax system and federal spending. Obviously, the United States has 50 state governments that have their own budgets, their own taxes, and their own spending as well. Unlike a lot of other countries, the United States does not just have administrative subdivisions. Our states are their own entities. They have their own taxing powers, their own spending powers, their own borrowing powers that they exercise independently of one another and independently of the federal government. And so you might think, well, look, they're all states. How different can they really be? But if you do a comparison between states, you actually find huge differences in the ways that they spend money and the ways that they tax. Some of the obvious examples are what taxes a state even has. Not all states have an income tax, for example. In some states, property taxes are for the state government and local governments. Some states, it's only for local governments. Some states charge personal property taxes on cars. Most of them don't. And spending is very different as well. The Affordable Care Act, known as Obamacare, allowed states to expand the Medicaid program to new populations beyond what the program was originally designed for. And 40 states have done that, but 10 haven't. Some states have universal school choice programs. Other states don't. And because of that, because of all those differences between states, we can look and see what's working and what's not working. David Ditch with the Economic Policy Innovation Center just did a recent article comparing New York and Florida. Now, this is a pretty good comparison because these two states are similar in size, population-wise. They both have very diverse populations, and that's true whether you look at ethnically, linguistically, economically. They have poor areas and rich areas. They have urban areas and rural areas. And both states have really, really huge economies on their own. If they were independent countries, New York and Florida would be two of the richest countries in the world. They'd be top 20% or so. And New York and Florida have very, very different state budgets. So New York state budget for next year is $254 billion. Florida's is about half that. Florida now has a slightly larger population than New York. And Florida's population is increasing while New York's has been slowly declining. And yet, New York spends about twice as much money. The New York state government spends about twice as much money as the Florida state government. How does this show up? David does a couple different comparisons. So first thing he does is he just looks at total state government spending per capita, meaning per person. Right? So that removes the problem of population. Even though, like I said, they have pretty close population sizes. But let's completely remove that. It actually makes New York's spending even higher than Florida's. New York spends 133% more per person than Florida does. So that means they spend twice as much, and then on top of that, another third per person. New York always spent more money per person than Florida, but in 2000, 25 years ago, it was only 30% higher. Now it's 133% higher. Enormous change over a span of 25 years. Part of the reason for that is Medicaid. You can go back and listen to the episode we did with Paul Winfrey and Brian Blace where we talk about this. New York's Medicaid spending per capita, so again, it's per person. It's not because more people are on Medicaid or whatever. It's per person. Was 112% higher than Florida's in 2000. Now it's 208% higher. Okay, that means New York spends 3 times as much per person on Medicaid than Florida does. Now, again, a big part of the reason for that is that Florida did not expand Medicaid under Obamacare, and New York did. But not only that, New York expanded it more aggressively than any other state. In New York right now, about 44% of residents are covered under Medicaid. 44% of the people in New York get their health insurance through Medicaid, or the state equivalent of Medicaid that they have called the Essential Plan. So David writes, for perspective, in 2024, New York spent nearly as much per person on Medicaid as Florida did for its entire state budget. New York spent $4,551 per person just on Medicaid And Florida spent $5,076 per person for everything that the state government does. So again, this is just showing that these two states, they're both states equally, but they have completely different budgets, completely different spending priorities. Then David goes and looks at education spending. New York's education spending per student is the highest in the country. They spend about $35,000 per student in New York. Florida spends about $13,000 per student. So again, New York spends almost 3 times as much per student. Again, it's not because they have more students. In fact, they don't. They spend 3 times as much per student, almost 3 times as much as Florida does. And you might be thinking, well, New York must have a lot better education than Florida does. And these comparisons are usually difficult to make, so take it with a grain of salt. But David says that 4th grade reading level in Florida, they rank 3rd in the country. And in math, they're 4th. In New York, 4th graders rank 36th in reading and 46th in math. So Florida has one of the best results for 4th grade reading and math. New York is in the bottom half, despite spending 3 times as much money. Now again, even if they're getting the same results, it's crazy to spend 3 times as much money to get the same results. But they're not even doing that. And then David makes the point that Florida has surpassed New York in population, and it continues to boom. From 2000 to 2024, New York's population grew at 4.5%. Total over that whole span, it only grew 4.5%. And it peaked in 2020. So it's been declining since 2020, but it's still higher than it was in 2000 by 4.5%. Whereas Florida's population in that same span has grown by 46%. 10 times faster. That's how it's been able to surpass New York in population. And they're not spending more money per person coming in to the state. Florida is one of those states that does not have an income tax. And so, what should we really take away from this? It's not necessarily that Florida is better and New York is worse. It's that there are really big differences between the way that states govern each other. There's really big differences between state budgets. And we should look at the trade-offs that these different states are making and say, does this seem reasonable? I would say that education number especially does not seem reasonable at all. I think New York is spending way too much money on that. Maybe you think Florida should spend more. Maybe they should. But the starting point we need to come at it from is not that all states are basically the same or that the United States is just sort of arbitrarily divided up into 50 little boxes. States actually matter. The decisions the politicians make there matter. And we should always be sure to remember that when we're talking about state level policy. Another issue in state level policy that has come up recently is about Amtrak funding in Texas and Oklahoma. Amtrak has a service called the Heartland Flyer that goes between Oklahoma City and Fort Worth, Texas. How Amtrak works for most of the country and for most of its services is that state departments of transportation put up some money to keep the service running. So in addition to whatever you pay when you buy the ticket, behind that, there's a bunch of government spending, and it doesn't come from the federal government, it comes from the states. Even though Amtrak is a federally run organization, and it's in this weird kind of in-between space where it's really supposed to be run like a business, but it also gets a bunch of government backing. But let's just say it's a national organization. The states are the ones who actually fund the Heartland Flyer and a lot of other services outside of the Northeast. How it was going to go this year is Oklahoma was supposed to put up $4.5 million for it. Texas was supposed to put up $3.5 million for it. So that's $8 million between the two of them. That was supposed to help run this service between Oklahoma City and Fort Worth. The Texas legislature exercised some of that power that it has, that I was just talking about earlier. States have their own budgeting powers. And they said, no, we don't want to fund that. So they did not give Amtrak the $3.5 million a year that they wanted in order to fund the Heartland Flyer. Oklahoma said that they wouldn't make up the difference, so now Amtrak is saying, we're going to have to cut off this service if we don't get any money from Texas. So this gives us a good example to sort of look through the arguments that Amtrak is making and seeing if they're making any sense. President of Amtrak, Roger Harris, he said, reliable rail service provides a vital transportation option for residents and visitors alike, strengthening regional mobility, economic development, and tourism. He said that in a statement urging Texas to spend more money. Now, that's all fine, but let's see what is actually going on with the Heartland Flyer. I would say, in my view, that I wouldn't describe it as reliable or as vital, like Harris does. According to the Federal Railroad Administration, the on-time performance for the Heartland Flyer was 66% in the first quarter of this fiscal year. It was 58% in the fourth quarter last year. It's at points in 2023, it was below 40%. There were quarters where it was around 80%, but it's never been above 80%. And it spent a lot of time in coin flip territory, where it's basically heads you get there on time, tails you don't. I wouldn't call that reliable, personally. Now, Amtrak would tell you it's not our fault. We have to defer to freight trains. But the reason they have to defer to freight trains is that freight trains are a lot more valuable than passenger trains are on intercity routes in most of the United States. They make money on their own. They don't require $8 million a year of government subsidies. And the freight trains are the ones who own and maintain the railroad tracks. So, it kind of makes sense that they're the ones who get to take precedence. And that's especially the case when you consider how many people are actually riding this thing. So again, vital, if something's a vital transportation, I would expect it to be used by a lot of people. And Amtrak says that it's used by 80,000 customers last year. And that kind of sounds like a lot until you consider that there's 365 days in a year. So that's about like 200 people per day. And when you think about Oklahoma City and Fort Worth, Oklahoma City metro area has about 1.5 million people. Fort Worth is part of the Dallas metro area. That has about 8 million people. So 200 people per day between those two places, that is really not vital. I think they would do okay without it. Big part of the reason why is there's already an interstate highway that connects Fort Worth and Oklahoma City. It takes about 3 hours and 15 minutes to drive, and the train takes about 4 hours. So why would people want to take 45 minutes longer on the train just so that they can get to either Fort Worth or Oklahoma City and not have a car? So they won't really be able to get around very well once they get there. You can understand why people mostly don't think that this is worthwhile. And the real sign that it's not worthwhile is how much money Amtrak is asking Oklahoma and Texas to put up for it. Again, I said, between the two of them, it would be $8 million a year. Amtrak said that passenger revenue from this line is only about $2 million a year. So the passengers who are paying for the service are not coming anywhere close to covering the costs that Amtrak is undertaking to provide it. They've basically said, without the money from Texas, we can't do this. So if that's the case, then it's pretty clear that people don't actually want this. Now again, 200 people a day want it. But then you have to ask yourself, would they want it if they were actually forced to pay the full price? Because as it stands right now, it's very heavily subsidized. If you take that $8 million and you divide it by the 80,000 passengers, that's $100 per passenger that the Oklahoma and Texas state governments are putting up in order to provide this service. So if the ticket prices were $100 higher, would 80,000 people still be riding it? Of course not. If you raise a price, fewer people will buy it. That's just basic economics. And so if you just took away the subsidy and you made people pay the full price, it would be less vital. And even at the subsidized price, it's not very vital at all. There's a really basic cost-benefit analysis fail in here. Amtrak said in its statement that, one of the reasons we need to keep this going and one of the reasons that this is good is that they're investing over $63 million in station improvements in Texas to help for access for disabled people. Now, not all of those stations are on this line. And of course, ensuring access for disabled people is an important thing to do. But Amtrak just said that they're only raising $2 million from passenger revenue on this thing. And they're going to spend 30 times that on improving stations for access for disabled people? That's crazy. Again, the station should have access for disabled people. I'm not saying that they shouldn't. But that's assuming that people are actually riding it. If you're not coming anywhere close to covering your cost on actually providing the basic service, it's crazy to spend 30 times that much on something that should be in addition to the service, not costing more than the service itself. Amtrak also said that the Heartland Flyer generates $5.3 million in direct economic benefits. Even if we stipulate that that's true, which it's probably not, anytime you see economic impact numbers like this, you can pretty much always disregard them. It's a very hard thing to measure in and of itself, but also it's usually the result of hack work by consultants who are paid to make the number look good. But let's say the $5.3 million is correct, for sake of argument. Texas and Oklahoma combined are spending $8 million a year for $5.3 million in economic benefit? That's not a good deal. Even better, the mayor of Gainesville, Texas, said in the Amtrak statement that the service supports, and this is a direct quote, almost 30 full-time jobs. Not 30, mind you, almost 30. Let's be generous and say that it is actually 30. That means Oklahoma and Texas are spending $266,666 per job. There is no way those 30 people are making that much money. There has to be a more efficient way to employ people than to continue this program. And finally, Amtrak says that You're going to need this service because Dallas is hosting World Cup matches in 2026. It says ending this service would weaken regional connectivity and hinder Texas's ability to deliver a world-class experience. Really? I mean, first of all, soccer fans from Europe or Japan are not going to be impressed in the slightest by an American train from Oklahoma to Texas that takes 45 minutes longer than driving. It doesn't even make any sense to take the train because the station it gets to in Fort Worth is like 15 miles away from the stadium where they're going to play these soccer matches. But even if the train went directly to the stadium, the World Cup doesn't last that long. It's not a reason to spend $8 million a year for the entire year to get this service. Now look, if the government really wants to keep a non-car transportation option available between Oklahoma City and Fort Worth, there's a much cheaper way to move 200 people per day. Buses. People can already take a Greyhound bus. Private sector already provides that between Oklahoma City and Fort Worth if they want to. But I'm not advocating for that. There's already a perfectly good highway there. And 95% of households in Oklahoma and in Texas own at least one car. So that means they already have access to the best way to get between Oklahoma City and Fort Worth, which is driving. So, good for the Texas legislature. I think they did the right thing here. And it's a good example of cutting wasteful spending, and you'll always get these arguments from the groups who are harmed. Look, Amtrak is going to be harmed by this. It's true. Almost 30 people could lose their job. In reality, they might not. Amtrak can just reassign them somewhere else. There's other things to do. But you have to think about where would that money be going instead? Texas apparently decided they had something better to spend the money on. I don't know if that was actually the right decision. I don't know what they're going to use that money for instead. But I do know that the arguments being made in favor of continuing this service are pretty weak, and Texas will be just fine without it. Now it's time for the paper of the episode. But before that, if you've enjoyed this episode, please subscribe and leave us a positive review wherever you get your podcasts. It helps us to know that you enjoy the show, and it makes the show more visible for others to start listening as well. I let Adam pick the paper of the episode from the American Economic Review in September 1945. If you already know what it is, you get bonus points. By F.A. Hayek, The Use of Knowledge in Society. Here's Adam to tell you about it.
So one of my favorite economics papers, and it's a classic, so I'm sure if people are familiar with it, is Hayek's 1945 essay, Use of Knowledge in Society. And I picked this paper to talk about because for me, it was the eye-opening moment. It was the first economics paper that I read where the light bulb really went off that markets matter and central planning fails. So basically, Hayek's core insight is that knowledge is decentralized throughout the economy, and prices aggregate that knowledge that's dispersed across millions of people, businesses all around the world. And price on any given product aggregates all of that information so that the consumer doesn't need to know why the price of eggs went up. They just need to know that the price went up, and that means that there's fewer eggs on the market, and maybe the marginal consumer will buy fewer eggs, and that sort of coordinates supply and demand and makes the entire economy work. And it's ultimately the missing insight in basically every economic policy debate we have going on right now. Politicians want to manipulate prices, whether it be through rent control or through the minimum wage, or through credit card interest limits are currently in the news. And all of these debates miss this point that the price that's being charged is carrying a lot of really important information. And when government gets involved and caps the price or subsidizes the price in the case of tax credits or other subsidies, you're giving consumers the wrong signal, and it puts the full market sort of out of whack. and that has costs ultimately in people not coordinating properly across the economy. And it's sort of the core insight of the paper is then that a central planner or someone in Washington isn't able to do that market process or get that price right sitting in a building here in DC. It's not that central planners are stupid. It's that they're trying to do something that's impossible, that only that decentralized coordination of the market process can do through the price signal. And I think it's the key missing insight or the key missing thing that people don't understand when they're engaging in policy discussions. So, it's a classic, but it's one that's always worth going back and rereading.
The Use of Knowledge in Society by Hayek. Read it. That's all for today. Remember, the economy is complicated. Nobody has all the answers, but markets work.